How's it going, everyone? It's Sam. I want to talk to you today about the coming market crash. And I'm talking about it today because the markets are down. The indexes are trading a little bit sideways, but a lot of the spec plays are down pretty significantly. So I've had a lot of people asking me about my cash position, what I would hold in cash, and just how I think about buying into stocks on dip. So I want to cover a lot of that here today. I'm going to try to keep it nice and short, though. I'm not going to go on for 20 minutes about this. I'm going to try to hold your attention to the end. So if you guys don't mind hitting the like button, I really appreciate that. Please hit subscribe too if you haven't already done that. We do videos every single day, sometimes multiple times a day. And while we're talking about the market collapse today, I do want to say one guarantee, a guaranteed return, is to go get your free stocks from WeBull. So there's a link down there. If you deposit $100, you can get some free stocks on there. It's guaranteed that you'll get some free stocks as long as you have a new account and deposit $100. So guaranteed return for you, and it helps out the channel. I really appreciate it. And there is a link down there if you want to know exactly what I'm buying and selling in real time. There's that link down to Patreon. So the markets are trading a little bit sideways. A lot of people have been talking about the coming economic crash or the coming market crash. Unemployment is falling though, so more people are going back to work. There's also a lot of money being pumped in through the Fed. However, a lot of people are saying, okay, a year or two down the line, the Fed is going to have to raise interest rates. Stimulus is going to be stopping here, hopefully in the next couple of years. We aren't going to get stimulus forever. They're not going to keep on pumping and increasing liquidity in the markets. So eventually people are expecting a pullback. Now, I think there are a couple different ways to think about this. One, if you're an index investor, an index fund investor, or if you have a diversified portfolio of a handful of different stocks, dollar cost averaging might be the best thing to do. Now, I know, I'm sure a lot of you have heard about this, but if you haven't heard about it, dollar cost averaging is putting money in regular increments into different investments. Now, instead of holding for a dip, you just throw it in consistently. And I found this really interesting article, how even God couldn't beat dollar cost averaging. And basically what they did was they looked over the last 100 years, and one person threw in money every week. One person waited until there was a dip and then bought in. And the reason they say that even God couldn't beat dollar cost averaging was because this other person that was waiting for the dip literally had the bottom of the dip every single time. They could know exactly when the bottom of the dip was before they invested their stored up cash. And the thing is, the person that put money in every single week actually did better, which is crazy. So the thing is, when, let's say it starts at $100, right? Like the index that you're investing in, then it goes up to 110, 120, 130, 140, and then it dips 10%. Well, it goes from 140 down to 126. But if you're buying the whole way, you'd still be better off than if you had waited for that. So that's something to keep into consideration. Now, if you're not investing in index funds, it's a little bit different, right? Because some stocks are hit harder. There's opportunities to buy into different stocks, different ideas come up. If you're investing in index funds, you're pretty much just putting it in the same spot. When you're investing in individual stocks, you might be able to jump on a Tesla or some penny stock like BNGO, which we got at $1.25. And if you have the cash available and you feel strongly about it, that's great. Now, for me, I believe that there is going to be a coming market crash or a collapse or, correction or anything like that. There's a market correction every 1.84 years. There's also a market crash that's a little bit more significant that usually comes, I believe, every 10 years. The average stock market crash lasts about 6 months. So it's not going to be this giant thing that's going to last 20 years, hopefully. Hopefully it just corrects itself pretty quickly. I mean, look at the last one. It was corrected in a few months. But I do believe it's good to have some money on the sidelines. I mean, on this channel, we invest in a lot of individual stocks. I believe it's important to keep some money on the sideline. Now, I personally have a lot of cash on the sideline, not because I think there's going to be a market collapse or anything like that, but because I am saving up for a house. So I have a significant portion because I'm going to have to pay for the house in cash because of my work situation that a bank won't actually lend to me. So I have a significant portion of my money in cash. Now, if I did not have anything to save up for, let's say I had a $100,000 portfolio, I would try to keep anywhere from 10 to 20% in cash. Now, any more than that, and I think you're really hampering your investment returns, And anything less than that, I think, if you want to go that route, you can, but I like having a little bit more. That way I can get into different opportunities that arise. I mean, there have been so many stocks this year that if we didn't have cash, we wouldn't have been able to get into. And you don't want to necessarily sell off positions, have to claim some gains on those too. So I think, anywhere, even if you want to go a little bit lighter than 10%, but I really like 10 to 20% in cash. And I think that's really good for either, again, buying new stocks, or if the whole market dips, you can buy up some of your other positions again and increase your positions. Now, I will say, if you are interested, there is a link down to BlockFi. This is one strategy that I think I will implement again once I have more cash that I'm putting into long-term investments, because again, saving a lot of my cash. I use BlockFi. I've been using it more to invest in cryptocurrencies, as you can see here, about 11,000 of Bitcoin and Ethereum, but they have stablecoins which don't fluctuate in price. If you've seen my last videos, this is the same number that was in the last couple of videos because it does not fluctuate in price. It's tied to the US dollar. So they actually pay 8.6% interest. So if you really want to try to save up for some market correction or something like that, this would not be a bad place to put it, because right now there's an 8.6% APY on GUSD. So you could store cash up here, get interest that's accruing at 8.6% a year. Now, of course, you have to look at the risk reward of that. I do have a link down to them down below, but definitely research the company. I feel comfortable with it, but I would definitely check it out because that might be a good place to store some money. Now, I will say one other thing that's important when going into a stock market crash, I think, is to be well diversified. So I hold a lot of different companies. I probably hold too many, but I'm sitting around 45 to 50 different companies. So that does diversify me in case there's a dip in only one sector. Now, people might be wondering too, when's the best time to buy when it does start to dip? Like today, we have a lot of spec plays that are down. I have been buying different stocks recently, but I've been buying them when they're even much lower than today. Like, we have a really large amount of returns in some of these plays. So if CCIV, let's say, which is rumored to merge with Lucid Motors, if it drops 5% today, I'm fine. I'm still up a lot on that stock, and I don't want to buy in when it's this high up, but I'm also not selling just in case they do merge with Lucid Motors. So I'm taking these on an individual stock basis. I really like to see things that push the stock down that I think are irrational. A lot of the time with these penny stocks, there are share offerings and it can drop the share price by 10 to 30%. I think that's irrational because a lot of these companies need money, and then as soon as they close the offering, then it goes back up. So I would keep that in mind. I would keep some cash there ready. Now, I'm not saying not to go buy the dips. I'm not saying to go buy the dips. I'm not a financial advisor, so do your own research, read up on this. But I have a good portion of my money in cash in case there is a huge correction. I will take advantage, but I'm also not trying to panic sell either. I mean, I think there's always a time to trim some positions. I'm interested to see what happens throughout the rest of the week because honestly, the first day of a drop is always the worst, or the second day, because it's not really low enough for the most part to feel like you really are getting a great deal, especially if you're up 50 or 60% in some positions. But 4, 5, 6 days in, you're like, okay, these are some pretty attractive prices I was buying last time. It might be a good opportunity to buy again. Now, if we keep on moving up, that's nice too, just because your accounts look a little bit better. But that's something just to keep in mind. The first and second days are always the hardest for me when I see a lot of red in the market and it was so green, and it's still not attractive to buy at. But I would consider saving some money, putting on the sidelines, and being ready for some kind of dip or even just an opportunity in a new stock. Now, let me know your thoughts on this below. Let me know how much you like to keep in cash. Again, there is a link down there to BlockFi and WeBull and my Patreon. I'll also put up the next video on the end screen about a stock that I was buying yesterday. Thank you guys so much. I appreciate it, and I'll see you in this video. Bye.